There are many questions regarding how to place stop loss order and which techniques to follow. Although there isn't a single approach that is better than the other, knowing your options and how to place stop loss with different techniques is very important. So today we will go through the most commonly used method for setting stop orders. Essentially, a stop loss is the predetermined price at which you exit a position in order to limit your loss or protect your profit. A stop loss is all about the exit strategy in your trading plan. Choosing which type of stop loss to use depends on the goal of your trading strategy. For example, for swing trading strategy, it makes sense to use the whole stop loss to allow the price to rally and return as the trend raises. If you are short-term trades, a smaller stop loss will hug the price actively and help you to not give back too much profit when the rally finally ends. No matter what type of the trades or inventors you are, but my advice is to always use a stop loss order. Every successful trader knows where they will get out if trades go against them. They plan every trade before getting into it. Some trades are scared that if they place a stop loss they broke will try to cheat them by moving the price to the stop loss level causing a loss. This does happen, but it's not a conspiracy. Getting stopped out is just part of the trading, and the stop loss itself isn't the problem. The point is that every trade will take losses and have their stop losses hit a lot. Therefore, using a stop loss isn't really a question. As the trader, you need to control your risks and losses, especially when using the kind of the leverage that is available Forex trades, for example. So let's discuss the alternatives in the term of the stop loss placements. First one, moving average. Moving average are popular tool and they can also be used to manage stop loss orders. Usually a trade will use a moving average and then place the stop loss on the opposite side current price. In the example, as we take the long trade, we could move the stop loss below the 20 MA as the trend unfolds. The moving average is the hertz, also potentially ideal when it comes to the finding a trading stop method. A potential trade happens once price breaks the moving average. The big questions about such a stop loss strategy is which type of the moving average to use. A fast moving average will get you into about the trades relatively quickly because it's reacts faster and price change. A longer moving average is usually better suited for the swing trading when you aim to ride trends longer. And of course, during the range market, the moving average doesn't provide much help because price does fluctuate a lot around the moving average. Next type, previous swimming points. This is probably the second most popular way of the placing and managing stop loss orders. Here you identify the natural swing points on your chart and place your stop loss below or above those points of interest. The trades exist happens once price breaks such swing point. Also, many trades use intraday highs and loss or previous day highs and loss to set their stop loss orders using this method. If you are a breakout or range trader, this is the ways of the placing a stop loss orders to be adjust slightly, and you should look for support to the resistance areas to place your stops. Third, another alternative of the Fibonacci levels. Using a Fibonacci stop loss approach is easily interning because it offers a more objective way of the placing stops. Whether you have to make decisions suggested when you move a stop base on the moving average or a slight strategy. Fibonacci levels don't have this component. Once a trade has down Fibonacci levels, its potential stop loss level are well defined. In this example, we drew the Fibonacci 2 during the downturn and then used the retention levels of the trend to stop loss. The trade exit happens once price favors the move to the next relevance level. 4 pivot points are another great way to set the stop losses. Pivot points are even more objective than Fibonacci levels because they are not set by the trader, but adjusted every day based on the price actions. The way pivot points are used is the same as the Fibonacci. Whatever price breaks a pivot levels, the stop loss is the trade below the level. Pivot points are many favorite of the setting stops and managing traders because they are adjusted based on the price actions, market volatility, and movement. During a stronger trading market, pivot points are set furthest away, and during a lot of the volatility market, they are closer together. Fifth, we also have the volatility stop losses. Traders often set their stops too close to the volatility in high, or they set stops too far away when volatility is low, and those reduce their potential reward risks. A volatility stop is just the pivot point adjust based on the market context. Furthermore, a volatility stop loss can be combined with the previously discussed stop loss techniques. For example, if you are using moving average to place stops, you could add the volatility stop loss to understand how close or how far you have to set your stop loss for the moving average based on the current volatility and the market context. There are several indicators you can use to take the average of the volatility stop losses. Tendering exit is one of those indicators. Tendering exit is based on the average turn range indicator and is designed to keep trades in the trend until the defined trend reversal happens. Also, Bollinger Bands are a rarely method as the stop loss tool, but its usage is to strengthen the valuation markets in natural candidates. For instance, the lower band works well as the stop loss for the long position and the upper band for the short position. As the Bollinger Bands is not designed for the stop loss tool, it waits when the volatility is high. Hence, when you see all the stop loss tool, remember to ignore the part of the band moves away of the price. Adjust the stop loss on direction of the trade, and finally, parabolic SAR is another indicator that introduce the both price time to place stop loss. Now let me cover the most common errors, regular stops placements to avoid you want to take the best trading decisions. First error is to determine your stop placements in advance. You should know where your stop is going to be before you open the trade. The same goes for your entry and trades. The benefit of the assuring your stop before you open the trade is that it removes any emotions from the decisions because you haven't yet risked any of your capital. Second error, placing your stops based on probability numbers. The market doesn't care about your risk reward, some magic 2% away from your entry, or some other figure. One of the biggest errors you can commit to try to make the market fit your framework as opposite of the fit your framework to the market. While it be very convincing in the were some magic numbers for equal you could apply to get the whoops for stops placement. No such things exist, my knowledge. Therefore, when it comes to deciding where to place your stop loss, and decisions should be based on the technical analysis. Stop placements should be based on some magic price level which meets the sensitivity percentage of the given you the desired error. The market doesn't care for that. Another major stop loss mistake is to moving your stop to break even as soon as possible. The goal of the stop is to protect you from your trade's idea go to work out, and it's not too often to the risk-free trade to the movement it moves in your favor. Most people would agree that the stop should be based on the technicals, yet happy to move their stop to the breaks even if the price moves their favor. This is the contradictionally moving your stop to break even the similar calculations your stop placements based on the arbitrary numbers. The market doesn't care when the enter to your break even. The moving your ability more your stop to be safe. You also abandon the technical base approach the position unless of the course you break even happens to the convinced a technically significant level. Another mistake is never moving your stop as mentioned as the goal of the stop projection. Your account if your trade ideas incorrect. However, once the market provides you that your trade idea may occur as moves in the expected directions, your stop can be used protectively to maintain the good error as the price hits towards your target. If your bindly moves your stops to the break-even as soon as you can, that's the arbitrary decision which isn't based on the techniques. It's an emotional decision to feel safe. But if you move your stop at the market proves that it's moving to the expectational direction, that's decision based on the technical and a good way to maintain a good error as price hits towards your target. The right value of the stop loss comes down to your trading time frame, your backtested strategy result, and what you feel comfortable with. There is no right or wrong on the single approach better than the another, but it is important that you understand the pros coins of the each approach to them, how combine different aspects to them, from trading methods based on your preference and the personal trading mistakes. As always, if you learned something new and found value, leave us a like and show your support. Subscribe to our channel and hit the bell icon to stay notified when we upload new videos. Until that next time.